then, the world economy has experienced the worst recession since the 1930s, followed by a very, very uneven economic recovery. The COVID pandemic has not only caused unparalleled disruption worldwide, but it has also exacerbated structural weaknesses in many developing countries, leading to substantial job and income losses. Let's be clear here. The economic impact of the crisis has been much, much worse than the health crisis alone in developing countries, given the severity of the lockdowns and the limited social safety nets in place, and also the limited fiscal space to react to the new situation. As a result, the World Bank estimated last June that close to 100 million people had fallen into extreme poverty in 2020, especially in South Asia and Sub-Saharan Africa. This is historically unprecedented increase in global poverty. This crisis has also partly changed the profile of global poverty by creating millions of new poor who are more urban, better educated, and less likely to work in agriculture than those living in extreme poverty before the COVID crisis. Lastly, the economic recovery of 2021, which hopefully will last, has been extremely uneven, showing a growing divide between industrialized and developing countries. The best illustration of that is that labor markets have not recovered in most developing countries compared to the pre-crisis level. All this suggests that so far low-income and lower middle-income countries have been severely impacted by the economic crisis, potentially unraveling most of the development achievement of the last 10 years in terms of job creation and reduction of inequality. In this new COVID-19 context, any progress in terms of SDG, Sustainable Development Goal, will have to be reassessed. What is certain, though, is that the financing gap to meet the SDG has grown substantially bigger since the last edition of Building Bridges. But this new reality is also an opportunity for the different impact investing players to show that they can make a difference and deliver on the impact promises. They first need to keep investing in SDG-related impact theme and also become innovative to leverage additional capital. And this is precisely the purpose of this meeting today, this afternoon. Let me now turn to the role of development finance institution, the so-called DFI, in this scenario. I think first it's really important to recall that their very raison d'être is to be there in difficult times with a long-term focus. DFI have a unique opportunity to act in a counter-cyclical way, even if it means absorbing some losses in the short run in order to be able then to lead other investors back to emerging markets in the medium term. This is also an opportunity for the DFI to show collective strength and be at the front line in helping local private sector to keep businesses afloat and also build back better. This is exactly what happened in 2020 when the 15 DFI from Europe, including CFM, put quickly together a financing facility of 280 million euro in order to provide financial support to businesses and local financial intermediaries affected by the crisis. DFI were able to act very quickly because they have a long-standing experience of collaboration under the umbrella of EDFI, EDFI being the association of all the European DFI, the 15 of them. DFI also have an important role to play to leverage further financing from private investors, both in local market and internationally. What has been the track record now in mobilizing private capital from the DFI? According to the British think tank ODI, bilateral and multilateral development finance have been successful in increasing the amount of private capital each year through their operation prior to the crisis by about USD 30 billion. However, it is a fact that most of this financing has targeted higher middle and lower middle income countries, while low income countries have only received 6% of that total. That illustrates the most difficult challenge for development finance in the years to come: how to scale up investment in difficult environments in a commercially viable way. The development of blending instruments and innovative structures have created new opportunity to mobilize private investors, and we will hear more about it later this afternoon. But there are obviously limitations to what can be done when investors are simply not compensated for the higher risk that they have to take in very difficult contexts, such as low-income countries. CIFM, like other DFI, in cooperation with the Swiss Development Corporation and SECO, is experimenting with new models to make progress on this front. This year, 2021, marks also the 10th anniversary of CIFM. As I said, CIFM is, or CIFM stands for Swiss Investment Fund for Emerging Market, and it is the Swiss Development Finance Institution, fully owned by the Swiss Confederation. And it is also an integral part of the Switzerland, or of the Swiss Instrument of Economic Development Cooperation. CIFM role is to provide long-term financing to private businesses in developing and emerging countries by investing in local and regional private equity funds or debt funds, or by providing credit line to local banks and other financial intermediaries. CIFM invests with other DFI and private investors. The portfolio is heavily geared towards private equity, with nearly 2/3 of the portfolio being in private equity, while current income earning asset making up another 1/3. Seeding, nurturing new private equity manager in developing country, which in turn invest in local SME and other fast-growing company, has been a very successful way to maximize the outreach, to leverage local expertise and build capacity, with a view to build a sustainable development of local financial markets. To date, CIFM has profitably invested more than $1 billion through more than 100 local intermediaries, providing finance to over 500 companies across more than 70 countries. About 1/3 of the portfolio is in emerging Asia, another 1/3 in Africa, 15% in Latin America, and the rest being in transition country. In terms of impact, CIFM priorities are set by the Swiss government in the form of strategic objective assigned for a specific period. For the current period, which goes from 2021 to 2024, this priority revolves around decent job creation, economic and social inclusion, gender equality, and no surprise, climate change mitigation and adaptation. Private capital mobilization is also at the heart of the CIFM mandate and a key priority for the Swiss government. And this is where OVIAM, the manager of CIFM, plays an important role. Since the beginning of the CIFM story, OVIAM has been able to raise close to $170 million in the form of bespoke private mandate, which are co-invested along CIFM in emerging markets and developing countries. To our knowledge, this is the highest amount that any DFI has raised for private equity co-investment strategy without any form of first loss tranche or public sector seed capital. This shows that the dual objective of achieving both an acceptable financial return and a measurable development impact is resonating with private investors as well. There is ground for optimism as the interest in impact financing opportunity is growing, based on a wealth of lessons learned in terms of what can work, what has not worked, what could work better in the future. This is precisely the purpose of this session, bringing together different players in the field, public, private, civil society, sharing and learning from this experience and coming up with new ideas on how these different players can complement each other. This is probably one of few positive upshots of the crisis, very few. It has made us realize that we should work all closer together to achieve our goals. I wish you all an excellent afternoon, and thank you for your attention. And I would like also to wish to thank SSF and SECO for having put together this session, which I'm sure is going to be very stimulating for everyone. Thank you.
Thank you so much, Claude, for this introduction and the view of the importance of state investors. And I think it was quite impressive how you illustrated how they managed to pull private investors along. So definitely we will hear more of this kind this afternoon. But before that, we want to take a bit of a broader view. And I'm happy to invite Frédéric Bernet to the stage. Actually, he also jumped in last minute because Patrick Elmer is not feeling well. So Frédéric, Chief Risk Officer at iGravity, thank you for being with us and telling us about their in-depth report about the Swiss impact finance system. Frédéric, thank you.
Oops. Just trying to find the Good afternoon, everyone. I'm wasting precious minutes of this very heavy afternoon. So I have the pleasure to jump in for Patrick. As you will see, pleasure to present a little bit where the Swiss ecosystem on the impact side is looking for. Trying to see, here we go. And you will see on the second part of this, we also talk a little bit of a SECO study that was mandated by SECO already more than a year and a half ago. So it looks very rosy on these pictures, and I was, when I looked at the slide, I said, Patrick, I can't say this, Switzerland is not leading impact investing, and you have to look very carefully, and I think that's an interesting thought that we had through the whole afternoon. I heard it many times. It's clearly the impact investing is growing. Here you have a number which is official. The new numbers have been already extrapolated in other meetings this afternoon. We're close to the famous 1 trillion in impact investing. Needs to be proven next year if that gets published. But in Switzerland, we are very champion of helping the South. When we talk about private investments, North-South, the private is really leading with 38.4 billion. That's a third of all these investments which are done out of Switzerland. So this is something to be proud of, but how did we achieve this? How do we get there? And I have a couple slides to share with you. It's intentionally very small so you can't see that, because some people don't see their names there and they come back to us and they say why, and so we have to basically add them up. Obviously, it's a dynamic view. It's super complex. What I want to show you here is that we have a lot of asset owners in Switzerland. They're doing impact, many of them on their own. There's obviously banks and asset managers. They're on the two extremes of this chart here. And obviously the public sector, the research at the bottom. We have fantastic universities in Switzerland. And the links are kind of a bit strange here. That's probably what I want you to remember of. We have some colors where they're located in Zurich or Geneva. There's purposely not a big link between Geneva and Zurich, because, except of the train, it's probably a bit missing. And I think that's a huge opportunity for this country when you see the amount and the variety of what is out there. So, Claude mentioned it a little bit already, how to build an ecosystem. I'm sure you can face and identify yourself in one of these pictures, whether you're an entrepreneur, the talent, or where you may provide access to market. What's really needed is the mix. How do we mix these people together? And if we're talking to find the right recipe, we better find the right ingredients to make it work. What I want to spend maybe a minute or so on this slide, where I think it's quite interesting to put some of the strengths we have in perspective. We have of course, a leading private banking franchise here in Switzerland. When I talk to the private banks, they all have a different definition of impact. And it's very unclear what is ESG or impact, even for some of them. When we come to the diverse ecosystem I mentioned earlier on, the interaction between them, I mentioned Zurich and Geneva. So I'm born in Geneva, I live in Zurich, I can tell you more if you want after the break. But also between the international organization and the financial community. There are potential links there that can certainly be improved. In Switzerland, we're the pioneer of the microfinance. I worked 6 years at Blue Orchard. I can tell you also more about this. And so we're very proud. This is a very big industry in Switzerland. However, outside microfinance, the innovation is a bit slow, I would tend to say. And then proximity to the UN. Of course, we have this chance to be in Geneva, have all the charitable foundation. We talk about 100 billions of capital out there. Now, how do we leverage this? Is it really integrated in the ecosystem? I'm not too sure. Then talking to the academy, I mentioned before, we're not talking about just university, which probably the country in Switzerland, and I don't know, but it seems to me that there's a high density of university for the geography. We have additional postgraduate academics center, and yet the number one problem we have is the lack of education. When you talk to people, it always comes first. While the people selling the products don't know what we're talking about, is it impact ESG, and so how can it be? And I'll go on the asset management capacity. We are very strong in Switzerland, and yet one of the big gap that we have today is how do we manage impact-first investments? How do we do that? The de-risking and so on. And I'm going to stop with the regulatory hurdle because I'm sure I will have a chance to talk about them later on. This picture is also very interesting. We're talking about huge achievement of impact, the 1 trillion. Well, the 1 trillion is 1%. So it puts it in perspective. Here it's not even 1. And obviously the ODA is a bit smaller than the impact, and that's why we're trying to bridge the gap between these two and trying to eat up a bit of the other square. And I was in the train looking at this graph, and I thought about, all the hype that we have today with the blockchain and the cryptocurrency. If you knew today where is the market capitalization of this industry, well, it's equivalent to the SDG funding gap. It's 3% today. Tomorrow it might change a little bit, but we're talking a huge amount that has been achieved just in a couple of years. So a few thoughts as well before we move to some of the needs that we were able to collect. I think the challenges we face as an investor is really the limited product universe. You go to your bank today, you want to invest in impact, there's not many products out there, if any. There is no Bloomberg for impact, and clearly the investments we want to do, they have limited track record, and so it's basically a bit of a question how you want to do that. There is clearly no impact certification. I think we talked about this a lot during these days. And think also something to remember is what we observe by being very active in the impact is a trade-off between liquidity and impact. The more impact you want to achieve, the less liquid it can be. You're not going to be able to daily trade this investment that you do in some of small countries for different purposes. And finally, the financial returns. What return should I expect? Is there a premium to pay for impact or not? I think a lot of studies have shown that this is not the case. And I think one of the explanations is still a misperception of the risk. If you look at the microfinance and the default risk they've achieved over the years, it's clearly a much smaller risk than many of the investments you do in developed market. As the same applies to the public side, the least developed country receive only a small piece of the blended finance effort. I think Claude mentioned the number just earlier on. It's exactly that and is a big challenge. I think there would be also limited evidence for how to best do blended finance. How is it the best way to de-risk deal? There's few studies out there that tells you should give a guarantee or you should make a first loss or a combination. That's also a big question. And finally, a number to remember: finance first. People are driven by return. So if you take a study on all impact investors, how many of them would be ready to give up on financial returns? That number goes down to 20%. So you could say it's still 1 out of 5 that is willing to seed or help blended finance. I still see it relatively positively, but to remember that the financial return is still a big issue. So what can we do to remain at the forefront? And then we were very happy at Gravity to be able to help the SECO in doing that study, which started February 2020, I think. That was just before the COVID, so we were not really able to meet people one-to-one, but we still had in excess of 30 one-to-one meetings, did a lot of workshops and interviews, and we had the support of Swiss SSF and SDG Lab as a steering committee during that time. Now, for those who don't know how long we discuss about this, when this study came out, it came also with a set of little documents with it. And there were 2 complete business proposals how to make a center. And there were 2 additional papers on how to do some sort of grouping and cooperation work. And each of these come back to potentially 2 to 3 years before that. So I can reasonably say it's more than 4 or 5 years, and I'm sure nobody here that is based in Geneva would disagree that discussions are ongoing about potentially doing something to bring these actors together. So what came out, and it's not revolutionary, but there are a couple thoughts to think about, and I put them all here together because that's what came. So of course, on the left, you have the impact management standards that was clearly mentioned. On the right, interestingly, and this was a year ago, regulation. Regulation was there, says there need to be some area regulated. A lot of impact investment can only be done with qualified investors. The foundation have trouble to do impact investment because of tax reason and so on, and I don't want to go into detail here. And the central part, I put some circles around there. It's clearly the need that we're talking here. So, how can we help de-risking? How can we help finding new innovative finance model to help innovation grow? And on the right circle here, talking more about to talk about education and how we can streamline this, having a common view on these issues around impact. What was interesting is the prioritization. We also discussed that. So one key comment came back is that saying 88% were really favorable of creating such a regrouping, a need for finding public-private initiative, saying that it was extremely urgent. And that the top 5 activities came up with the first one being the policy dialogue. Again, focusing on potential issue with regulations. You see came second the de-risking, which obviously talking about guarantee, first loss, and on the third, the education and training. And then last, I would say, come in the discussion, they're still quite important here because obviously you have different sectors, the design window and the impact validation. We discussed a bit in detail on the ideal structure. I don't want to go too much here in detail. I think that's not of interest. I think the last slide is probably more about the summary of these different views that we had. So clearly, one common that came together was the need for a vision. It's what can we do to basically address the root cause of the system to make it work. There was a strong push for having a Swiss leadership there, and that it's excellent that it comes out of Switzerland, showing, I mean, the complexity of the ecosystem we have could certainly afford to have a leadership in this. And then the activities that you see here was the supporting innovation, making sure we can scale products that is extremely needed today, whether it is by creating liquidity on the exchange or whether it is by, you know, providing this sort of first loss capital that makes the perceived risk at least not so risky. And clearly third but not least, the impact standard. And the tools, I think I've talked quite a bit about the tools yet. I think the tools is really the next step. So I think stay tuned. As Sabine said, there is a lot of announcement coming during the afternoon. And hopefully the whole effort that we did here, which I tend to say sometimes to Patrick, it looked like an elephant. And there is a big say in French, let's hope that the elephant doesn't give birth to a mouse. So thank you.
You just stay here for a second, please, because we do have time for one or two questions, if there are any. There's a microphone in the room here that we can hand out if anyone would want to address a question to either Frederick or also Claude, if needed. If that is not the case for now, yes, there would be one. Katja, could you pass her the microphone, please, just in front of you? Ah, sorry.
Thank you so much. Very interesting presentation. What were the main concerns of the partners you were in dialogue with all these 5 years regarding this project? If you can, by the first top 3 concerns, because I think that's the... this morning we heard somebody, we need to have the cynical voices around us on the table to give them a voice to understand why it's not going farther, better, and in a larger dimension. Thank you.
So, well, before we say it's not going further or better, I think I would be careful because it's going finally forward and it's going well. I think the divide, you know, in Switzerland is not easy to group these people together. The channels of connections are simply not always there. I mean, we obviously have the Building Bridges Week, but it's not happening so often. That's certainly one of the concerns. And the second one is to see this is a very complex topic, and to de-risk and to put finance in impact first, you're obviously taking a higher risk, and so not everybody is prepared to do that. So the financing of all this was not always put in the same level of discussion.
So maybe we can measure progress by the size of the font on your slide on the ecosystem. I thought it was impressive how small the font is already because of the many players that you have on them. So I think we stop here. Thanks a lot, Frederick, for your contribution. And I now have the pleasure to hand over to Miriam Garçon to manage the next round, which will be especially interesting as there will be a few pitches of impact investors. So let's see what this ecosystem looks like.
Thank you, Sabine, and welcome everyone from my side as well. It's a great pleasure to see all of you here. In the next session, actually, we're going to see or hear 3 different examples of successful blended finance vehicles. They're all developed and managed by Swiss-based asset managers, so that's really confirming actually what we have seen on the beautiful slide, like the fact that actually the Swiss impact ecosystem is already impressively large. So this is about learning a little bit, but it's also actually a nice showcase of building bridges, bridges between public and private capital, but also between north and south. So it's going to be a little bit challenging because every manager gets 5 minutes presentation. And I'd like to start with Kim-André Potvin. She is partner and head of operations at Bamboo, and she will present the Build Fund.
Hello, I'm very happy to be here. Despite having only 5 minutes, I hope I will be able to give you a concrete example of a blended finance fund. Just before I dig into the description of the fund itself, I would like to say a few words about Bamboo Capital Partners. So we've been in operations for the last 15 years, investing in 3 sectors: financial inclusion, agribusiness, and energy access. We launched our first blended finance fund in 2019 in partnership with IFAD, the International Fund for Agricultural Development. And in 2020, we launched the Build Fund in partnership with UNCDF, the UN Capital Development Fund. So I'm going to describe this Build Fund in my next 4 minutes. So the aim of the Build Fund is to invest in the least developed countries. As we saw just earlier, the least developed countries do not receive a lot of investments and a lot of attention. And we believe that a blended finance fund was a way to attract capital to this region. So basically, we invest in SMEs in the private sector in these least developed countries. We have 4 areas of focus: financial inclusion, nutrition and agribusiness, local infrastructure, and also renewable energy. And we also have one cross-cutting area of focus that cuts across all of these 4 areas on women and youth. How does it work? Well, as its name implies, it's blended between public and private actors. So Bamboo manages the fund as the asset manager, and the UN Capital Development Fund builds the pipeline with us, sources investments and opportunities, and also participates to vet investments through our investment committees. So basically, we build together with our respective skills and competencies. In terms of the fund characteristics itself, so it's a debt and equity fund with a high focus on debt. It's open-ended with a target size of 250 million, with an average ticket size of 500,000 USD, with the ticket sizes that start from as low as 250,000 to up to 2.5 million. We invest in both local currencies and US dollars. It's addressing the missing middle between seed and growth capital, and so basically early stage businesses. We also provide technical assistance, pre and post investment through the builder facility. In terms of investors, we have, of course, DFIs, foundations, family offices, institutional and private investors. And what is most notable about this Build Fund is our anchor investor is the government of Luxembourg. So they provided catalytic funding through first loss. Since they are a member state of the UN, they made their contribution directly to UNCDF, which then invested directly in the fund. So I think the most interesting question now is why blended finance and what are the benefits? So there are many folds. It increases the impact of both partners that they wouldn't have on their own. So it multiplies pipeline opportunities. So to give an example specifically with the Build Fund, Bamboo invests already in 30 countries. UNCDF is present in 30 countries. So together some of the countries overlap, but you can see that we have a very large area that we can cover in the world. It multiplies funding. So of course, putting our funding together, it increases the size of the fund. We can deploy more investments on the ground. It allows also to invest in regions that would otherwise not be catered to, as I was explaining at the beginning. For private investors, it provides de-risking in terms of investments, and it protects their funding, because basically the catalytic investments in the first loss partner, they take the first hit if there is a loss in terms of investments. And for public partners, it's manifold in terms of benefit. First of all, it provides a more robust governance, much more transparency, of course, financial returns that otherwise they may not have had, and also it mobilizes further capital to a specific vertical or area of concern. So I think I'm in the 5 minutes.
Was great. Yeah, I would like to welcome Christian Renicoli. He's head of institutional clients at Responsibility, and he will present the climate smart food.
Thank you, Miriam. So I'm just waiting for the presentation that I can show you. So generally speaking, thanks a lot. It's a great pleasure being here with you today to tell more about responsibility and our capabilities in blending, in terms of blending structures. The presentation's got to be coming soon. So responsibility, we are active in climate financing and agriculture financing for more than 12 years. And with this blended finance structure, we are combining our expertise, let's say, in agriculture and climate, because we're going to engage on the food system level in order to achieve higher impact. And the food system is very, very important, even though in the future, because it accounts for roughly 1/3 of the global greenhouse gas emissions. And additionally, you see roughly 40% of the food is lost between harvest and consumption. And as well, the food systems is the main contributor to biodiversity loss, and this is because of deforestation. And when you see that we need an additional 60% of food in order to feed the world by 2050, so I think there is a tremendous need to engage as well on the food systems. So far, the majority of the investment solutions, they focus more on upstream, means they focus on land use, sustainable agriculture, but as well organic agriculture. But the food systems approach is going along the entire value chain, so from upstream to downstream. And here when it comes to smart climate intervention, so we are talking about mitigation, so they're going to use renewable energy in production, about clean vehicles, less packaging, and as well low carbon diets. It goes further to adaptation, which is going to be a very important topic because of climate change, so increase the climate resilience, but as well improve the water efficiency. And productivity, we have already talked about, we are losing currently 40%. So reduce food loss and reduce food waste, it's going to be a very important topic. But all these climate smart interventions, they need long-term fixed assets, a permanent working capital. And to just give you an example, concretely what it means, what do we provide, and that's a cashew nut processing company and dried mango. So they're going to use the loan, the long-term loan facility we're going to giving in order to triple the capabilities or factoring the capabilities. Means they're going to source from 3,000 farmers next to 10,000 farmers. They engage as well in renewable energy. They want to become a net zero factory. They're going to reduce the food loss because they're going to improve storage and as well waste management. But they're going to train these 10,000 smallholder farmers in order as well to improve the soil of the health, which is very important as well for carbon storage. So all this is important. They're going to be supported as well by technical assistance. But this is rather a new concept, and it's perceived as risky because we are financing directly these agriculture players in the entire value chain. And therefore, we think blended finance is the right structure and the right approach to reduce the risk. And it's threefold. It goes for different tranches we can provide. It enables us as well to leverage in term going up to 200 million with this product, but as well to leverage in the private sector capital. And what we have seen is that from our other blended finance structure, in order to reduce the risk, let's say a first loss tranche is quite important. So this fund's going to have 25%, but even there we have differences. You see, the German government has funded the junior tranche, but other public investors, they want to provide unfunded guarantees. I think even there we have differences. And one lessons learned from our bigger climate, let's say, blended structure is that notes are very important because institutional investors, they like to have higher protection, in this case roughly 70%. They want to have flexibility when it comes to maturity, let's say, for example, 6 to 8 years, but as well they want to have a fixed coupon, so a kind of fixed income. So I think even though blended finance is not standard within institutional investor, I think it's a good way in order to address the future needs and for the common good. Thanks a lot.
So much, Christian. Next, I would like to invite Tim Roche. He's the founder of Alpha Mundi, and he will present the Social Alpha Fund.
Thank you very much, Miriam. Good afternoon, everyone. My thanks to Swiss Sustainable Finance and Sustainable Finance Geneva for bringing us all together this week. So in the next 5 minutes, I'd love to tell you about Alpha Mundi and our public-private partnership model through the example of our Social Alpha Fund. Alpha Mundi is a company I created in 2008. We began impact investing in 2009. In the last 10 years, we've invested about $100 million across 50 small and medium enterprises. And most of that is not through financial institutions in developing countries. It's really directly to the SMEs. So one of the things that if this works, there you go. So we have an investment team in Latin America, in Colombia, another one in Africa, in Kenya. We have a foundation team in the US and a small representation office here to interact with our investors and our partners. I think what's really important is the main features of our Social Alpha Fund. This was a fund registered in Luxembourg as a SICAV-SIF under the alternative investment regime. And as of this year, of course, it's subject to the Article 9 of the European SFDR. In general, we've had a very good run in terms of financial returns as well as in terms of impact. I think this reflects the fact that in the impact investing industry, we don't like to promise the moon, but we do like to deliver on our promises. And in the case of Social Alpha, you're looking at an average of 3% net per year in dollars over the course of the last 10 years, 6% on debt co-investments and 20% plus on private equity co-investments, because our fund investors have the right to co-invest directly in our portfolio companies. In terms of impact, we've currently have in the portfolio 22 companies that are employing on a full-time basis more than 4,000 staff. They are serving this year 360,000 clients, and 50% of them are female and 65% of them are rural, living in rural areas where greatest poverty is concentrated. Now, I just wanted to highlight these numbers because we're very much about facts and we are data-driven, and that is relevant for our private-public partnership model. One example of a portfolio company that went through all the benefits of our PPP is Sun Culture in Kenya. This is a company that was first identified by our foundation. Our foundation gave it a grant multiple grants, in fact, one of them to research and develop solar irrigation pumps and systems, another one to de-risk a lending facility for its clients, and of course, a third one to improve its gender lens considerations and the promotion of middle management skills so that we can empower women. This is a very important aspect of Alpha Mundi's mission. It is to make sure that gender lens is not just a CSR exercise, it's not just a governance exercise, it's really embedded in the business model of our portfolio companies, because these days you cannot identify risk and manage it effectively. You cannot identify business opportunities and seize them if you do not have a proper gender lens model. What's interesting here is that you can see the leverage ratios. So the $200,000 that our foundation gave as a first loss segment helped catalyze $11 million in lending facilities for the clients of Sun Culture. And we've also been able to help them raise $6.5 million out of the $14 million in equity round that they did last year and the $11 million that they raised in debt. So this is really the concrete benefit of having a business model where you have an investment group on one hand that can deploy debt and equity capital, and a foundation on the other that can deploy grant and technical assistance capital. in my last minute, my last slide. It's color-coded, so if you can't read the text, don't worry about it. On the left side, you see our Social Alpha Fund. So you've got two pools of capital. The first one is the investors, and my thanks to Lombard-Odier and Abendroth Stiftung for being the first institutional investors to invest in our fund a few years ago. And on the right, you have USAID and CEDA that provided a first loss guarantee to the fund that is still effective today. And of course, the fund invests in SMEs and also offers co-investment opportunities for its investors. On the right, you have all the donors who've contributed to the Alpha Money Foundation over the last 4 years since the foundation was launched. We have distributed more than $5 million in grants, in technical assistance for research and development, impact measurement, and new market expansion. And the idea, of course, is that the SMEs who benefit from the foundation progressively graduate to our portfolio. Thank you very much.
Thank you so much. Thanks, Tim. Yeah, I think these were fantastic showcases and really demonstrate the depth of the Swiss impact industry. Now we like to turn towards a DFI, to a public actor. Oh, and I'm actually very glad to see that it works, and we have Yvonne here. So this session is going to be about the role of a DFI, or actually the various roles a DFI can play, and especially in crowding in private sector capital. So I'm really glad to have Yvonne Backum here. She's the managing director of FMO Investment Management. I'm really glad to have you, at least virtually. Yvonne's obviously based in the Netherlands and would have not been able to travel to Switzerland. Very welcome, Yvonne.
Thank you, Miriam. It's a pleasure to be here.
Please, Yvonne, could you tell us a little bit about FMO's work? FMO is obviously the Dutch development bank, and we'd like to know a little bit about the role or the various roles that you play, just as a beginning.
Sure. Let me first congratulate you all with organizing this event and also managing the technicalities so well that I can participate in this hybrid format. As Claude Barras already mentioned in the introduction, since the pandemic, the need for development finance has only increased, right? The SDG financing gap has significantly increased. I read a publication recently which estimated the increase of 40%. So instead of 2.5 trillion, now we need 3.5 trillion per year. So this cooperation with private investors, between private investors and DFIs is going to be crucial to come close to achieving that. And well, you asked about FMO. FMO is a Dutch development bank operating in a similar space as CFM and other DFIs in Europe and worldwide. We have purely a private sector mandate, investing in 3 focus sectors: financial institutions, renewable energy, and agribusiness. And over the last decade, I have been focusing on working with institutional and other private investors. So mobilizing money to co-invest alongside FMO in exactly those sectors and those countries where typically these commercial investors do not have very easy access. And I must say that over these 10 years, I have really seen a clear acceleration. So in that sense, I'm very positive about the prospects for this kind of public-private cooperation. In the early years, our biggest challenge was really the fundraising, and we really celebrated every 10 million that we could raise. And we still do, because every 10 million is important, but in recent years, the amounts that investors have entrusted us with are so much larger. And I think that really speaks to the development of the impact investing market and the visibility of DFIs like FMO as partners for investing in emerging markets and developing countries.
So what you're saying is, and I know this, that you're co-investing either with private sector institutional investors, or you offer them the opportunity. And another way, obviously, is also that you invest in fund vehicles and also pretty often with catalytic capital. Is there an additional role that we haven't touched yet? And another question would be, has that changed over time? Like, is one of these activity fields growing stronger than the other one? Have you seen trends recently?
Yes, the mobilizing activities have grown most significantly. Another field that we have become increasingly active in is what we call, it's not a very sexy name, but we call it accreditation management, where we, in principle, we front international organizations like the Green Climate Fund, like the European Commission, who are willing to work with public institutions like FMO, but not directly with commercial fund managers. By putting ourselves in between that organization and the commercial fund manager, we also catalyze that public money towards more investments in emerging markets.
What do you think are still the major barriers when it comes to mobilizing more institutional capital? And I mean, we know these numbers, you have just mentioned a number, it's huge. What is, and how could we, do you have ideas about how to overcome some of them?
Yeah, before getting into those barriers, I would like to describe the impact investing universe as I see it. It's a spectrum, right? And on the left side, you have the really high risk pioneering activities for which you need public money, you need donor money. On the far right, you have the easy impact investments where institutional investors invest in green bonds or listed equities. And that whole spectrum in between those extremes is where DFIs work, and FMO works there as well. So we use public money, we manage some government funds for the Dutch government, and we use that money to pioneer and take risks that are high because it's about early stage, a bit like some of the examples given by the fund managers in the previous session, for which you need grants or high risk appetites. And then in the more to the right of that spectrum, we provide loans, we provide equity investments, and a selection of those loans is very attractive also for commercial investors. Others that are more to the left are not. And I think the key barrier to impact investing in emerging markets for institutional investors has to do with risk. The risk appetite, but also the perceived risk of the investments, which in our experience is not always correct. The perception is not always correct. So that's one of the barriers to overcome. And one way to overcome it is through education and explaining the actual risk profile of our portfolio. But there is also an element of de-risking, especially when you want to mobilize really large amounts, because you can see that without the de-risking, these portfolios have very high capital charges. So there's a regulatory barrier, actually. These capital charges are high, and that makes it unattractive for institutional investors to commit more than a symbolic amount. And you know, even for huge investors, symbolic amounts can be quite large for us. And if they can invest 20 million from some pocket, that we welcome that very much. But of course, we would like them to invest hundreds of millions or even $1 billion from their main pocket of investable money, and their de-risking comes in, and we can structure first loss. We can develop funds that have first loss component. And what we have learned in the recent past is that to overcome the hurdle of this risk element is to co-create. So it's not us developing a fund structure in our own office. It's about us sitting with the investor and together coming up with a structure that works for both of us.
Yeah, I think that's a super important partnership that you're speaking about. I'd like to come maybe back to the question of perceived risk. And I know that increasingly DFIs are sharing data. And as we know, there is still a bit of a lack of data available, especially when it comes to past performance, and obviously the impact industry is not yet so old. Is that something you're also providing?
Yes, we provide track records in quite a bit of detail when we speak to institutional investors.
And coming to the partnerships, so when you said you're getting in close collaboration with institutional investors, either directly or I imagine also through intermediaries. What are your learnings from that? As we know that sometimes, at least, the public doesn't speak exactly the same language as the private sector. What are your learnings about this? How to overcome these understanding gaps?
Yes, and in that answer, I would say that I don't consider FMO a public entity. We are majority state-owned, but we operate very much like a public-private entity. Of course, that's also what we are. So we are a great intermediary. In fact, we have said we built bridges between public and private investors. And because of who we are very well situated to do that. And indeed, there's not always the same language that people speak. Over the last decade, I have acquired a lot of typical commercial investor language for myself and my team, because we want to be able to be a good conversation partner and understanding also the needs and the challenges of the institutional investors. And on the other hand, of course, coming from this public ownership, we speak the language of governments, and we also understand that public donors, blended finance is a great tool, but there are some pitfalls, and public donors, for instance, don't want to subsidize commercial investors. So it's very delicate to make clear that everybody plays the role that they should play, and that what the public investor does is de-risking and not subsidizing. And of course, the risk cannot be seen separate from return. So if you de-risk, you improve the risk-return profile. But that's the sort of discussions that we are having.
And maybe sticking to this point on catalytic capital, which still is required to build ecosystems to help grow smaller funds or smaller companies entering difficult countries, etc. I think everyone agrees, and we heard it in several instances at this conference as well. A crucial question remains, like, where can we mobilize more of this capital? What are your thoughts about this?
Well, we have found there are many sources of catalytic capital, and FMO uses catalytic capital on the one hand to pioneer, And there we use a lot of government funds, we use European Commission funds, we use Green Climate Fund, and we also use catalytic capital to mobilize, so to de-risk structures for institutional investors. And there we also work with large foundations. So actually there is a lot of capital available. One sort of observation that I would like to make is that too much of this capital is actually too inflexible. So the requirements that the donors attach to the capital, for instance, it must be climate in least developed countries, or it must be just sub-Saharan Africa, or it must be a particular country. And that makes it quite difficult to use the catalytic capital in a, for instance, globally diversified loans portfolio, where you cannot link it to precisely those limited frames that the donor has put. And of course, I totally respect the policy objectives of the different donors, but I would have a request for them to also consider broader products that are more easy to embed in an overall structure.
I'd like to ask a last question before we also take one or two questions from the audience. Turning to the institutional investors you're working with, or not yet working with actually, do you think they're overseeing some opportunities which you think they should look at? And how could we address this as an industry more, well, in a better way?
Yes, I think they are overlooking the huge potential of emerging markets. And I think there is still a tendency to think about these markets, especially the least developed countries or the low and middle income countries, to think about these countries as something very scary, and to think about investing there as something almost charitable. But we always try to emphasize the huge business opportunity that is also available in these countries, and the possibility to co-invest alongside DFIs like ourselves, and thereby also benefiting from our experience and our knowledge in those markets.
Absolutely. Thanks. I'd like to take one or two questions from the audience, if there is. Will be a question from Christian, Yvonne, that you probably remember, Christian Speckert.
Yes,
you cannot see him.
I cannot see him yet.
Yeah, Christian Speckert here. Thank you very much with all the content you provided. Fully agree with it, of course. No, just one challenge that I also see if it comes to blended finance, that I tend to see little discussion, and that is like the complexity and probably the cost to set up, the legal framework, the structuring, having, tremendous cost included as well. And my question to you is, wouldn't it make sense to have like modules, like a toolkit of blended finance, up or down to the level of, a standard legal documentation that specifically probably for smaller organizations could really be very useful and could lower the entry barrier if we talk that much about blended finance? Thank you.
Yes, that's a great point. Actually, for having a systemic impact, you need to approach blended finance not from a deal-by-deal perspective. So indeed, I fully agree with you that a bit more standardization would be helpful. So far, we haven't seen one structure that is the same as the other. So there is a lot of diversity. It also has to do with the different requirements of different donors and investors. But I do agree standardization would be helpful. And the flexibility that I advocated in those instruments may also help. But at the same time, I think we also need to use the donor money to set up the structures and to take the early stage risk of developing a blended finance vehicle before you know for 100% that it's going to work. Because that is, of course, a serious business risk. And I'm proud that FMO has also taken that business risk. We have taken it ourselves in the case of Climate Investor 1 and now Climate Investor 2, for instance, a blended finance fund manager that we co-initiated. But it was a few years of investing serious time and capacity in a program that nobody knew for certain that it was going to work. And of course now it works, and now everybody says, why don't we have much more of these vehicles? But that's because taking this kind of business risk is not, it's not something that everybody can afford. So there, donors can also help.
Yeah, I think very good point. We can take one last quick question. Please, yeah.
Thank you very much. My name is Francisca Núñez. I work for IISD. I'm very impressed by all this blended finance model. I would like to, please, Yvonne, if you can elaborate more in what I believe it is the first purpose of blended finance, which is to promote sustainable development. And while instead de-risking, which is always very welcome, it's maybe more just like the tool to achieve sustainable development. Thank you very much.
Yes, thank you very much for pointing that out. Of course, blended finance is a means to an end. And the end is generating positive impact for people across the globe and to improve environmental and climate conditions. That's first and foremost. And yeah, I think it's good that you say this, because especially when we talk technicalities, we sometimes forget why we are doing this and why we are talking about blending in the first place. It's not because blending is so nice or exciting. It's because we want to have more impact. And the DFIs alone and the public sector alone, I was quite shocked actually by this percentage of only 6% of ODA going to the least developed countries. So it's clear that public money and DFI money alone cannot solve our huge global challenges. So together we stand a better chance.
Well, thanks. I think this is the perfect word or sentence actually to terminate this conversation. Yvonne, it was so good to see you, to have you here. Thanks so much for your contribution, and goodbye to the Netherlands. Thank you.
Thank you very much, Miriam. It was my pleasure, and these 20 minutes have gone so fast. I wish you a good afternoon, all of you there.
Thank you.
Great. We have this opportunity to zoom in people from anywhere. Thanks a lot to Miriam for moderating this part. I thought it was incredibly interesting to really hear about some practical solutions, but we also heard from the DFIs that it's sometimes hard to crowd in the institutional investors, and that especially pension funds often fear investments in developing countries because they think of high risk. Now, I'm all the more glad to now introduce Grégoire Hanny, who is the CIO of CPEG, the pension fund of the Canton of Geneva, and he's an example or a representative of an example of a pension fund that thinks of it differently and actually does see an opportunity in impact investing. Please show us your concept.
Thank you. First of all, I'd like to thank Building Bridges, Sustainable Finance Geneva, and Swiss Sustainable Finance for the kind invitation to speak. Let me first start by reminding you the 4 asks of the European Union. The first ask is manage the carbon emissions and the temperature of your portfolios, of your investments. Secondly, engage, invest in impact investing solutions, and disclose. The ask number 1 and 4 are crucial, but more importantly, Engagement and impact investing have a direct impact on the environment and from a social point of view. As you may know, I'm the vice president of the Institutional Investors Group on Climate Change. The IGCC is the oldest and largest activist group in Europe. This year has been a very successful year for us, and the 26th of May is a major milestone for engagement. And this is all boiled down to a collective effort. And the same applies for impact investing. It must be a collective effort. I've took a lot of notes during the conference and the summit, and there are interesting quotes that I've heard. The first one is from Chairman Patrick Audier, walk the talk. Another one is, are we here to talk, are we here to network, or are we here to fight the climate? We need a collegial effort, we need scalable solutions, and we need a commercially viable solution. And this is all about the project that I would like to present. So I have now 9 minutes to present you a project that aims to have an impact for the next 50 years. So the idea here is to syndicate investors towards a public-private partnership with the government. So we have identified the EIF, which is the largest and the oldest impact investor in Europe. And the concept here is to invest in scalable investment solutions where investments do not flow necessarily. We know the pandemic will be solved by technology. I'm thinking about the vaccine, but the same applies for the environment. We need to have a revolution in terms of technology, and we need to direct the flows into that direction. But nature is also a concern, and social issues are another one. Today, we're talking about nature, and nature also needs to direct flows into that direction. So here the objective is to create a syndicate of investors, and we'll have here 2 boards, an investment committee, as well as an advisory board, which will be composed of anchor investors. And from the full process until the impact measurement, the whole process will be controlled by those 2 committees. There are a few advantages of this project, and the first one is, of course, invest with the largest impact investor, i.e. the European Investment Fund. The second is to be by construction EU taxonomy compliant. The second one is to benefit from the EIF's research and monitoring capabilities and a robust investment process. And of course, by syndicating this group of investors, we can customize governance and the portfolio construction. We have access to co-investment opportunities and a full alignment of interest. But there are also constraints. The first one is we need to catalyze multiple participants with potentially different objectives and values, different objective of the SDGs that they want to prioritize, and this is one of the big issues we have to deal with. The second one is we must deliver multiple returns, and this is the triangle that we mentioned before. The first one is risk, return, and of course, impact. We need a third-party independent impact measurement once the standards will be accepted. We want to launch this project with a minimum of 100 million commitment, and it has to be scalable to be meaningful. We had our first working session yesterday, and 3 members of the EIF came to Geneva in person. We had the head of the impact social and the head of impact of the environment, and then we had connected a member of the EIB, the European Investment Bank, that sits on the investment committee. So they are taking this initiative very seriously. So there are 2 possible outcomes. The first one is it doesn't fly, but we will have outcomes and lessons learned that we can convey to other investors who can focus on those constraints. And then the optimistic option is that this flies and we can scale it, and we can also replicate this model that we're trying to implement. So I think the ultimate objective here is to create bridges between investors and also governments. And thank you for your attention.
Thank you so much. That was a fast 9 minutes, and I would say in that case, we could also take a question if there was one, seeing that the model is so innovative and hopefully crowds in other institutional investors too. Is there anyone who would want to bring up a question? maybe two. Yeah, there is one.
Hi, I'm Ben Banerjee from Swiss Impact Investment Association, and I'm also on the board of CLC, the Climate Leadership Coalition, which is Europe's biggest business organization. Did I understand you correctly that you mentioned that we can solve climate change with technological innovation only? Or I was wrong in that?
Well, innovation is one of the dimensions that you're trying to tackle, but there are other dimensions. It's a little bit of everything, and there's no one-size-fits-all, obviously.
Exactly, that was my question, because we know for certain that technology is not going to solve us in the climate change. We need a lot of other policies.
Well, to be honest with you, I have no idea, but I have a strong conviction that technology is going to save us, which is the case in other situations.
Okay.
So it may not be the case, but at least we have to give it a try. And if there are no funds flowing into that direction, then we have no hope on that end.
Yeah, thank you.
I don't see another hand up, so let's say thank you to Grégoire Hanny for giving us an insight into this. Well, we now are probably ready for a break after these dense inputs in the first half. We will serve you coffee outside for 30 minutes, but please be on time after the break, because that's when we really have the interesting announcement, and we will be joined by State Secretary Marie-Gabrielle Eichenfleisch. So please be on time and don't let her wait after the break. We continue at 4:30 sharply. Thank you. So can I please ask you to slowly take a seat? We would like to continue. So I would like to thank you for joining us again after the break for actually the most important part of today's event. I allow myself to say this without wanting to put down the previous speakers at all. But we're very honored to have State Secretary Marie-Gabrielle Eichenfleisch, Director of SECO, with us today. She has joined us, and she will announce the launch of the SDG Impact Finance Initiative today, an initiative that was prepared with the support of many experts, and it was endorsed by SSF and its board. She will be joined here on the panel by 4 partners and supporters of the initiative, and actually I can ask them to the stage already now. It will make it easier afterwards. And I ask to join us here Laura Hemrika, Managing Director of Credit Suisse Foundation, Gurdin Duschleta, Head of Community Affairs and Foundations at UBS. We then have Guido Beltrani, Co-Head Inclusive Economic Development Team at the SDC. And last but not least, Roland Dominice, CEO of Symbiotics. So they will all wait. Roland, if you could take this seat, please, over here. They will all wait to hear the announcement of Mrs. Eichenfleisch. So can I please ask you to join us here? We're really excited to learn about this initiative. You can go there, whatever you prefer.
Thank you very much, Sabine Döbeli, for your kind welcoming words. Thank you also for this joint event. Dear partners from the public and private sector, dear event participants, dear panelists, I am very happy to be here to be able to announce today officially the SDG Impact Finance Initiative. Imagine we are 2030 and the world is taking stock of SDGs. We recognize that any single actor cannot actually address individual SDGs on its own because problems are too complex. But imagine also one of the success stories in achieving the SDGs is impact finance. If this is the case, we want Switzerland to be its global hub. Now, why such an initiative? I presume we would all agree that we need new forms of collaboration to reach the SDGs. The good news is that there is more capital than ever to potentially invest into the SDGs. However, there are still too many barriers when investing in developing countries. Unfavorable risk-return profiles, regulatory aspects, to name just a few. Now, how can we tackle these challenges? As director of SECO, I would like to first underline, what I underline every time I speak, the importance of conducive framework conditions and structural reforms. Beyond that, blended finance, that means the use of public or philanthropic money to increase private sector investment, can address some of the existing gaps. It is a pleasure to announce the SDG Impact Finance Initiative at the second edition of the Building Bridges Week. In fact, it was at its first edition in 2019 that Swiss private sector actors working in development finance called upon the Swiss authorities in a joint development finance declaration. Albeit it took a while, we are here now to officially announce the SDG Impact Finance Initiative. Along the way, we could build on the inputs from many stakeholders. I am also pleased that the UBS Optimus and Credit Suisse Foundations joined us so early in shaping and bringing this public-private partnership to life. I thank you all for the valuable inputs in this process. You all have invested some sweat equity in this initiative. Now, successful public-private collaborations require also coordination within the public administration, and therefore this initiative is coordinated with our colleagues from the Swiss Agency for Development and Cooperation, SDC, where is Mr. Beltrani? Here. And the State Secretariat for International Finance, SIF. Ladies and gentlemen, let us now dive a few minutes into the what and the how of the SDG Finance Initiative. First, I'm glad to confirm the approval by our President, Guy Parmelin, for 19.5 million Swiss francs of SECO funding to this initiative. This sends a strong signal that the public sector is committed to scale, quality, impact finance, leveraging the Swiss ecosystem. Second, I would like to underline just a few general principles. The initiative will select the best ideas through international and competitive calls for proposals. And such proposals must demonstrate that, first of all, that they have the potential to mobilize more private capital, then that financing on similar terms or quantities in the market is not available, and thirdly, that the proposal can demonstrate a measurable impact, emphasis on measurable, in developing countries towards the realization of SDGs. Third, let me explain what the initiative aims to do, and we have three objectives. First, it will support the development of new and innovative financial solutions through grant and seed funding. We call that the innovation window, which is especially targeted at probably smaller companies, but all the companies that have good ideas. Second, it will scale impact finance solutions by mobilizing more private capital and strengthening underlying portfolio companies. This we call the product window, which is targeted towards investment funds and portfolio companies. And thirdly, the framework conditions. In cooperation with Swiss Sustainable Finance and the Swiss authorities, this initiative will contribute to improved framework conditions in Switzerland and promote impact management practices. Before concluding, I invite you all to think about what makes Switzerland so competitive and so innovative. Now, of course, there is a large ecosystem of criteria and of developments, of how do you say, conditions, let us call it like that. But I would like to highlight two which I think are especially relevant in this context. The one is the strong integration into the global system. And secondly is the dedication to quality. We consider these two aspects also critical in this initiative. And this is why we want to build upon the strong ecosystem in Switzerland and connect it to global platforms, markets, and investors. And we also want to put high-quality impact at the center of the initiative as a trademark of Switzerland. So quality means that we produce impact where we claim impact. Now with this, I would like to turn to the panel and join you here. And I would actually like to ask a few questions. Now maybe starting with the partners, UBS Optimus Foundation and Credit Suisse Foundation. Thank you for being here. And maybe as a first question, what motivated you to support the establishment of this initiative? And maybe ladies first.
Thank you very much, State Secretary. Good afternoon, everybody. Thank you very much for coming today and for joining us for this important moment. Thank you, everyone, also and all our previous speakers for, again, outlining the challenges that are there for to bridge this enormous SDG financing gap that we know about very well and have known about for a long time. We've, as a global bank, and I'm sure UBS would say the same, we see that we have a very important role to play in order to channel financing towards the SDGs. But like many of you, we have been in many conversations where there is increasing demand and interest from our clients, which is fantastic, and at the same time, not yet enough opportunity to invest on that perspective. And on the other hand, many of you have been in conversations where you have important impact needs, important innovative opportunities to invest in, but struggling to get to the investors, the famous supply and demand problem. I don't want to be in that conversation anymore, frankly. So today's initiative is a key part of trying to address that issue. Credit Suisse has been involved, as many of you know, in impact investing since the early days when you were all talking about financial inclusion. In that context, we looked at financial inclusion as an investment opportunity for our clients, but we also supported that space from the side of the Credit Suisse Foundation when it came to capacity building and technical assistance, where we saw that in order to keep growing the communal impact that we can have through our investments, we also need to make sure that the sector can continue growing, that the enterprises on the ground are investment ready, that the many investment managers and asset managers, big and small, are given the space, the opportunity, the means to be able to do the innovation that is so desperately needed. And that's where we see what we learned in the financial inclusion space so many years ago, we know is also the case now when it comes to the broader impact investing space, especially when it comes to the SDGs, which, especially for the SDGs, collaboration is needed, creativity and innovation is needed in when it comes to the vehicles we develop, and it's a big challenge, a challenge that is, there's plenty of room for everybody, and in fact, it is only solved through the collaboration of many actors in the financial sector.
Thank you very much.
Yes, what can I add to this? Welcome, bonjour, allegro also from my side. Let me try and sum it up in like 3 key reasons why we're so excited joining this initiative. Reason 1 is because it's important. I think we've heard about the funding gap. It's huge despite all the efforts. There is so much left to do. There is no other option than partnering up and jointly solving it. I believe the gap leaves us with 2 conclusions basically. A, we need to attract much more funding, substantially more funding, and B, we need to ensure that we maximize the impact of every Swiss franc invested. So that would for us be reason number 1. The second thing is it extremely nicely fits our purpose. We want to contribute to creating a better world by reimagining the power of investing, and this initiative allows us to do just that. Third reason, and I think I speak on behalf of the UBS Optimus Foundation team I represent today here. The reason is we believe we can contribute. We can contribute because we look back at not only a foundation having made 300 million plus grants over the last couple of years, scouting programs, developing a sense for for finding and building up and nurturing programs which can deploy and deliver sustainable change and measurable impact. But at the same time, also quite a bit of expertise and experience got built up in the social finance, blended finance area. So remember 2014 already, the UBS Optimus Foundation launched the first DIP, the first development impact bond with Educate Girls in India. A lot of innovation has happened since, and I believe the team is super excited to bring that experience to the table in this initiative.
Thank you very much. Maybe also a question more general. I mean, there are many foundations in Switzerland, and what do you think is the role of such foundations in advancing this kind of investment? I mean, you are now 2 foundations coming from banks, but maybe where should we go and look for other foundations or philanthropic players for the future?
In order to bridge that enormous gap that we've all been talking about, it's our firm belief that many different kinds of capitals are needed to activate at different points across the spectrum and across the ecosystem. Philanthropic funders, with their very risk-tolerant capital, with their ability to test, to innovate, to drive new models, to investigate how different actors can work together, actors that may normally, just like today, maybe not always sit together at the same side of the table in a pre-competitive mode, in fact. This is a unique opportunity and role that philanthropic players can play in this sector. As you said, in Switzerland, we have a very large number of foundations. We have a wealth of nonprofit organizations, globally active ones. We're here in Geneva at the heart of many of those global organizations. So it's a unique opportunity for us to bring all of those together and to leverage those connections and that know-how, because in the end, especially in the space of impact investing for the SDGs, it is not only about the financial know-how, it is also the impact know-how, it is also understanding the local environment, the topics, the different components, as well as the finance. And once again, this is where the foundations, there's so many topics, there's so much to do across all the SDGs. There's some SDGs that get so much attention at the moment, but it's key that we don't leave any of these SDGs behind, nor especially developing countries as well.
Yeah, and I would absolutely agree. I mean, philanthropy can play a catalytic role in crowding in private sector money, government money, even mainstream capital, for all the mentioned reasons. I mean, philanthropists can absorb the first loss, they can take risks, they can finance the testing and trial phase, and this is essentially what our foundations have been doing, right? I mean, supporting projects up to the moment where you can have the proof of concept and you have all the possibility to then present the investment opportunity at a higher impact level in a de-risked way. And I believe, if I may add one observation, as a bank and as a wealth manager, our clients are super interested into the whole impact investing topic. And I believe impact investing at some point will become sort of mainstream, maybe in a similar way as sustainable investing has become mainstream and has become the default option for many of our clients. And in that sense, I believe we also have an opportunity to establish Switzerland as the hub for impact investing.
And I might just add, we talk about the financing gap, the large amount of money, but there's also that gap in understanding of each other that the philanthropic world can help narrow, whether it's on the right, de-risking so that we can get the investors more comfortable and moving closer to investing in some of these creative solutions, or whether it's actually increasing, therefore, the investment readiness, de-risking the quality of the investments, bringing that comfort level, or strengthening the institutions on the ground. So really trying to bring everybody towards the middle is where philanthropic capital can be the most effective.
Yes, and there has been a lot of discussion also on making this philanthropic work more measurable, you know, also here, and I think that's certainly a development that helps this kind of cooperation. Now, if we go beyond philanthropic, how do we get banks actually to get involved into this kind of work?
I think this is where there's a lot of hope and already demonstration effect of some of the examples we heard earlier today and that we've heard throughout this week with blended finance mechanisms, where indeed we can, you know, whether it's using those mechanisms to test and try a new vehicle or a new structure, so that it can then be replicated once we have that comfort level, whether it's providing guarantee capital, a signal of confidence, so that the banks can take on these products and promote them to their clients. These are some of the things that will help. And of course, the more there is out there, the more opportunity there is for our clients to get invested. Otherwise, you can't fill the gap with only a limited number of products. There are many different clients with many different interests.
And making it investable, as you said, and I also believe, and that's maybe building on the observation I shared. I remember when my colleagues at Optimus Foundation came up with very innovative blended finance, social finance solutions, that they basically had to go and find the right client and convince the client. And I think this has really changed. I believe the clients now ask for such investment options.
Exactly.
And that's why I believe this initiative comes at the very right moment in time, because the market is ready and we can jointly build that market. And I believe that's also where banks then have a crucial role to play beyond all the mentioned, the other mentioned contributions.
The access to the capital and also the expertise that all of our colleagues are able to contribute, and the experience there as well.
Thank you for these very interesting insights. May I turn to you, Mr. Beltrani? You are joining us, not yet, but soon. Can you tell us when?
In the first semester 2022, we hope.
Yes. We have a lot of testimonies here, you know, so.
Exactly. It's safe now.
I'm sorry, I didn't want to be too... No, but I know that this is on track. And of course, for us, it's important that, you know, we do that together. Maybe tell us a little bit, what are the criteria of your engagement in this kind of initiative?
Well, these are first thoughts. If we speak about criteria, I mean, we are very excited, of course, to join forces with the partners that launched the initiative, and we are very grateful to UBS, Optimus Foundation, Credit Suisse Foundation, and SECO for this, we believe, very, very timely initiative, which fits perfectly, I would say, to the current strategic orientation of the SDC, the Swiss Agency for Development and Cooperation, as we are really strengthening currently our engagement with the private sector, and in particular also with the financial sector. We have meanwhile more than 100 larger or smaller initiatives together with private sector partners, and an increasing number of them are with actors from the financial sector and impact investors. Now, looking into the future, speaking about our engagement or potential areas of engagement with SIFI, with the SDG Impact Finance Initiative, as a first step and in line with our recently approved risk management guideline, we have first to conduct a due diligence. And upon completion of this due diligence, as I said, we are confident that we could provide a financial support to the initiative and start concrete cooperation in the first semester 2022. Now, which areas are particularly interesting to us? Of course, we will discuss this together with all the members in order to increase synergies and also ensure complementarities. But first thoughts are to go there where the needs are the largest, basically. So if we speak about sectors, we all know in the blended finance space there are some neglected sectors, for instance, health, education, water. Of course, we are considering also to engage in topics that are dear to us, like women's economic empowerment or also adaptation to climate change. And if we speak about geographies, of course, this will be in the geographies in which the Swiss Agency for Development and Cooperation is active. So speaking about Sub-Saharan Africa, Middle East and Northern Africa, as well as Asia, and including, of course, least developed countries. We have heard it in previous intervention that only 6% of blended finance go to this country, and there is for sure there are for sure uncovered needs, and we think that SDC can play a role there.
Thank you very much. We look forward to working together. And one question to you, Mr. Dominici, or actually two. You are the CEO of an impact investing asset manager and also board member of Swiss Sustainable Finance. So can you tell us how this new initiative actually fits within the ecosystem of Swiss Sustainable Finance?
Okay, well, many thanks. Thanks for inviting me on the panel. It's true, I'm sitting here more with my hat as board member of Swiss Sustainable Finance. And before we go there, I think it's important indeed, you mentioned in your introductory speech, 2 years ago when there was the first Building Bridges Week, there were voices saying this is not only about building bridges in the sustainability world, but also just in Geneva between the West Bank and the East Bank of the lake. And, and so we wanted to make sure that the anchorage of the United Nations and of all its affiliates in Geneva was deeply rooted in the Building Bridges movement. And so we did a call to our authorities to make sure that the North-South dynamic was not forgotten. We were talking about don't forget the D in SDG in the sense that development finance is key to achieving the SDGs. It's really important to invest in Switzerland and Europe for the environmental transition, but it's fundamental if we want to reach our SDGs to be investing in the South very heavily. And so indeed, we started, I think the event was in October. We started in August, and I want to thank a lot of you who are here. Who signed. We gathered 65 signatures within 6 weeks, and we did an open letter to our financial authorities. And I want to thank them because I think not only SECO, but a lot of other federal departments responded very positively to this call. And one of the anchorage was to, let's say, affirm Switzerland as the logical place of business for impact investing in a north-south development finance meaning. And I don't know if we can say, do a claim for victory today, but I want to, of course, thank SECO. In particular, I think it's important there's people behind. So Liliana Dessau-Kirchnopf, heading the private sector department, was always, I think, very supportive. And they've changed jobs internally, but Lukas Schneller, Massimo Bloch, also your colleague Miroslav, and of course today picked up by Christine Lewis and Christian Brendli. I think it's important to testify the importance of public sector servants engaging in the dialogue with the private sector, and we have here an example of something that worked. And I also want to thank SSF, who picked up the flag of this Swiss Development Finance Declaration to try to implement it. And the key project we were working on with our colleagues at SECO was precisely SIFI, and I think it's an incredible tool. It's a unique initiative, and I think it really speaks for Switzerland. We saw yesterday with the results of the Tameo Impact Fund survey that indeed 35% of all impact investing funds, asset management, are managed from Switzerland. And we can see Switzerland as a terrain of innovation, like the incubator, if you want, in our space. We're seeing some of our shop being bought by foreign institutions. I think that's very healthy, actually, and it just proves. And so the way I see SIFI is really as cementing this Swiss signature of being the incubator of our space. And if I put my hat back on as Symbiotics, as potentially a beneficiary of that, we're, of course, extremely excited to know that we can go to a facility that can help kickstart, whether it's a fund, a new company, all sorts of initiatives, or different sort of framework conditions. I think the role of SSF in supporting CIFI going forwards will be on the regulatory side. We don't like regulation too much in Switzerland, so we talk about framework conditions. But I think CIFI is a perfect example of those framework conditions as not so much of a push top-down, but a pull, incentivizing our ecosystem to innovate with a soft but intelligent support from the states. So big thanks again.
Thank you very much. So you said very, very useful, timely, I thought so. It's not just one other initiative, nice to have, but you think it's really needed and it has a specific role.
Definitely, I think there's 3 windows, and of course we'll need to see how it implements, but there's so many funds that could scale up, but were never able to launch. And if I had the chance to be around 20 years ago when some of the first impact funds were popping up, and if it wasn't for that support of a private foundation or of a government support, just 1 or 2 million, that's enough to launch something that can scale to billions maybe a couple of years down the roads. And so again, I think in that way it's really fundamental. And I think it's unique in its setup. We're not saying that we have a new development bank that will take a lot of space in the room. We actually have something that's triggering a discussion with the private sector and sort of incentivizing and pushing private sector initiatives to, somebody mentioned that we need to become commercial and scale. And so to paraphrase Patrick Gaudier, we need to walk the talk. Well, I think CIFI will allow us to walk the talk on a lot of our new ideas.
Thank you very much. Maybe to conclude, from each of you, which is the most important single factor for a success of this initiative? I don't know who wants to start.
I can go, knowing a bit the dynamic in Switzerland. The special DNA that will be needed is a way to represent and consult with the private sector. So find an alliance in I would say, the selection committee or whatever it will be, of really be able to screen the whole sector in Switzerland. There's such a vast diversity and I think depth of knowledge. And so to find a way not just to work with 2 or 3 actors, but really have a view on the whole of Switzerland in terms of actors, or maybe abroad as well.
Shall I? Okay. Yeah, from my side, I would say the start of the discussions during the last maybe 6-7 months, and I was surprised to see how the language was a common language. So we have a first recipe for success. I would add, maybe ambitiously, that we hope that many other players from the financial sector may be sitting in the room, will join soon, like SDC, the initiative, maybe in the first semester 2022, and this will definitively contribute to the success of CIFI.
Maybe a couple of words. I think it would be being nimble, collaborative, getting on with it, and daring to innovate.
I find it tough to come up with the single most relevant factor, but I'm gonna get there. I'm gonna get there. But if I may build it up, I believe what this initiative will do, it will create a hub for learning, for exchange, for building joint shared standards, for building the ecosystem, building the market, and that's crucial, right? It will then, by doing so, mobilize capital and get others to join in, which is crucial again, because that will allow then, and I believe this is really the key reason why we joined the initiative, it will then deliver real, tangible, measurable, relevant environmental and social impact towards the SDGs. And so in that sense, if I have to name the one single most relevant factor, I would build on what we heard from the lady in the Netherlands before you joined, Ms. State Secretary. She said, let's not forget the impact we want to achieve. We don't do this this is a means to an end, and the end is the impact. And I believe let's not lose that impact focus, because that, I believe, is what really matters most.
Well, thank you very much. I think that was, I think I have to conclude, right? We could have continued for some time, but I would like to thank you very much. I think it was showed very well, first of all, that we're all very happy that we can start now. Very happy that you would join very soon. And I think that there have been said so many things that I don't want to repeat, but I think probably one of the important things is to cooperate and to see that, you know, we all have, you mentioned something about using the same words and, you know, sharing the same ideas, but also to reach out. And of course, we're very happy to have you all here and hope that one or the other, you know, will join in this initiative. Just to say that the first call for proposals will be in early 2022. This will be in collaboration with Convergence, which is an organization that has a lot of expertise in blended finance and will help us here to make the first calls and to start actually operationally this initiative. So I would like to thank you all very much. I said at the beginning that to 2030, you know, we should say it's a success, and Switzerland will be the global hub. So I hope to see you all here in 2030 and being able to say, yes, that's what we are. Thank you very much.
Well, I would like to thank Mrs. Marie-Gabriele Neichenfleisch for hosting this session, for using the opportunity to announce this exciting initiative here. And I'm sure you're as excited as I am to see who is also involved, that more partners will join soon and will make the Swiss ecosystem in impact investing grow further. And not just the Swiss one, as we heard. It will be an international competition that will start early. So thanks a lot. And I hand over to Miriam Garzon again for the next round. We'll again learn more about actual impact investment solutions.
Thank you. I think this is a perfect timing actually to start our second, pitching session, so to say. I think this initiative that was just presented, the SIFI, will actually support a lot of the innovation that we still need. But now we're going to look at some examples of what the innovation really means. So I'd like to welcome the next Swiss-based impact asset managers to present their examples of blended finance. We'll start with Emmanuelle Chavois. She's head of blended finance at Symbiotics, and she will present RegMIFA.
Hello, everybody. Thank you very much for being here. So, indeed, I will be presenting today the fund that is called RegMIFA, the Regional MSME Investment Fund for Sub-Saharan Africa, which was created 10 years ago. And this was created 10 years ago based on the idea and the identification of the problem that, first of all, Sub-Saharan Africa definitely has a problem with financial inclusion that is more acute than other regions of the world. So much less people have access to financial services in that region, and it's still the case. It used to be even more acute, but it's still the case. And also that Sub-Saharan Africa represented at the time, and still represents actually, a very low portion of the portfolios of the MIVs, the microfinance investment vehicles. And so the actors that gathered around this project thought that there was the need to create a tool to incentivize investors to look at Africa and Sub-Saharan Africa differently, and also to help promote the development of good quality financial services for micro-entrepreneurs in Sub-Saharan Africa. Just as a little number, usually microfinance investment vehicles have a proportion of investments in Sub-Saharan Africa that is between 4 and 8% maybe. Sub-Saharan Africa represents 15% of the world population and has a specifically acute problem with financial inclusion. So you see the type of problem that the fund definitely was created to solve, or contribute to solve at least. So the founders of the fund were KfW with a very strong push, and also the Ministry of Foreign Affairs from Spain. And those two players were really the main ones. Obviously, you see plenty others join the game, and quite a few of them are definitely very important actors in the fund these days, and are very present. So the structure that was created to tackle that issue was, what we, I think, can call a typical blended finance structure with 3 layers of shares. The most junior one being the one that's taking the full hit on the FX risk and the credit risk, and then the others taking, the risk as the potential risk might go. There is obviously also the option for the fund to have leverage with notes, and also a TA facility attached to the fund, with the idea that definitely there was the need to support the development of good quality financial services through something else than just financing. In terms of the track record, for the past 10 years, the fund has invested more than $500 million in financial institutions in Sub-Saharan Africa. That's been with roughly 90 institutions that we've worked with over time, and in 24 countries. The overall also, there was roughly 8 million euros of TA funding dedicated to supporting the institutions financed by the fund. In terms of the performance, the fund always served the target dividends on the A and B shares, so the least junior tranches, and also served on the first loss tranche an average of 2.3% of dividends every year. Obviously, the first loss tranche still suffered some losses through the credit risk, but overall, the fund only wrote off 1.3% of its total amount invested, so a track record that I think is nothing to be blushing about, and we're very proud of having been able to achieve this in a region that I think is less served by plenty of NYVs, because it's perceived as extremely risky. So definitely there is more risk, we've seen that, but it's not something that we can consider to be outrageous. So that was a very important demonstration to be made. And in terms of the current size of the fund, it currently is a $160 million of portfolio spread over 50 investees in 20 countries. And more importantly, 14 of those countries are LDCs. So I think it's important to say it's 100% Sub-Saharan Africa, and quite a large proportion are in LDCs. Now, in terms of the funding structure of the fund, right now it is a fund that has a 50% first loss. This is definitely because we plan to grow much further. So we just received at the end of last year a large new inflow from KfW. And we also have now 20% of notes, and a recent investment from GLS, which was an issuance of notes which was rated A. One thing that we did at the end of the first 10 years is to do an impact study, and it was very important for us to do that. We did that through 60 decibels, and 60 decibels, so interviewed 600 end borrowers of the fund. And the few results that were important to measure, first of all, 2/3 of the clients said that had no other access to financial sources. 85% said they didn't have any other good alternative to the services that were provided by the FI that they used. And 90% said they, through the life of the loan that they had, they improved their financial situation and their quality of life. This was significantly higher than the benchmark that 60 decibels has for the rest of the social interventions it measures, which is only 76%. Finally, I think we're very proud of the success we've had, and the plan ahead is to continue, expand obviously what we've done so far, but also address some challenges. We've widened the scope of what type of things the fund can invest in to be able to better serve typically agriculture, rural areas, which are a bit underrepresented in the fund for now, and also innovations in general. So we've widened the scope of the fund quite largely, and we've beefed up the first loss tranche to be able to embark on those new initiatives. Thank you very much for your attention.
I'd like to welcome Charlie Graham-Brown, his partner at SeaStars, and he's going to present the SeaStars International Fund.
Thanks, Miriam. Let's see. Do we have slides? Well, I'll get started anyway, because I know you're running a tight ship and we've got to keep on time. So thanks very much, everyone, for being here. And yeah, delighted to present to you SeaStars International Fund 2. Just so you know, I'm, as it says, partner and chief investment officer at SeaStars, and I joined the organization really back in the early days, about 10 months in, coming from Blue Orchard, where we were obviously focused back then on financial inclusion. And we got together with the other partners at SeaStars to try and figure out how technology and entrepreneurship could best be leveraged and combined to have an impact in emerging markets. And what we ended up doing is building two different verticals. What we started with is what we called SeaStars Community. And SeaStars Community has run activities in over 90 different markets and really supports early stage ecosystems and early stage entrepreneurs. And we do that through different tools. It could be running events like this, it could be running hackathons, it could be acceleration programs or incubation. Today, that team is managing in parallel, like this is live today, about 21 programs supporting 1,500 entrepreneurs around the world. The second piece that we started developing and where I started really focusing on in 2017 is what we call SeaStars Capital. And what we wanted to build here was a series of vehicles to provide early stage venture capital to high growth companies in emerging markets. And today we've backed over 75 companies. We've had just 4 failures and we're tracking at about a 20% unrealized IRR. I have 3 more slides and I want to share 3 sort of learnings or innovations that I think we've brought to the space. The first is with regards to the investment strategy. And we've been hearing a lot about de-risking and how can we provide channels for more capital to flow into these markets on a de-risked model. The first thing that we do is we take a look at the different models out there and we try and identify the winners. So we are backing early stage high growth companies, but we try and find models where that has already been de-risked, and that could be evidence from developed markets or more mature emerging ecosystems. And once we have those models, we try and invest in a basket of companies around the world building similar things. The second thing is the diversification. There are obviously high levels of political and macroeconomic risk, and all we can really do here is diversify. So taking, I guess, a leaf or a page out of other asset managers in Switzerland, we've been active in the global south, so we've invested in over 30 markets, and this second fund will have over 100 companies in the portfolio. And the final thing is how do we reduce the operational risk for the portfolio companies? And that's actually the next slide that I want to jump to, if I can. Not sure why it's not working. If you don't mind going to the next slide. Thank you. We took an approach of embedding the capacity building within the fund. So all of the capacity building we deliver to portfolio companies is run by an internal team. And I think this changes the dynamic significantly from perhaps what's more commonly done. The team is 100% dedicated, they have KPIs, they have objectives, and there's a continual learning mechanism whereby we just try and provide the most value, the best customer services essentially to the portfolio companies. There are 6 different mechanisms we use, but we really focus about 80% of our attention on growth. And again here, this is quite unique. And if you consider financial or the technical division in a company, it's the same for growth. It's a professional team that needs to run and manage growth, and that's a skill set a lot of people lack. And so that's what we really try and bring to the table. The final innovation, I believe we're the first Global South VC fund that has a blended finance structure embedded. And we basically have a 25% carve-out that is going to be dedicated for the IDA markets or least developed countries, which are those with less than 1,250 GNI per capita. And for any investments we make into those markets, there's a first loss guarantee of about 15%, or between 15 and 25%. And I think this is a fantastic innovation in the space. But if I was to share learnings, I mean, I've been seeing other presentations where that first loss coverage has been up to 40%. So I think that's obviously one mechanism to play with. But if I was to share some learning, at least from my experience talking to LPs and trying to crowd in the private capital, I think there needs to be both downside protection, but also some upside benefits. And perhaps by being more catalytic and allowing the private investors to share in more of the upside. Maybe it's wishful thinking, but it's Christmas, so that's my that's my ask for the room. That's all for me. Thanks very much for the invitation, Miriam. Thanks, everybody.
Thank you. Thanks, Charlie. Very nice. Well, I would like to welcome now our last presenter. Yeah, it's Alessandra Niviopone. She's lead fund manager in the Blended Finance and Impact Management team of Blue Orchard, and she's going to present the Insure Resilience Investment Fund. Thank you.
Hi, everybody. Thanks for inviting Blue Orchard, and thanks for the audience for being here today. So maybe before I enter into the Insure Resilience Investment Fund specifically, I just spend a few words about Blue Orchard. I only have one slide, so don't worry. So Blue Orchard is an impact investment manager with 20 years of track record. We started with the financial inclusion and private debt, so the 20 years were mainly on this asset class and thematic, but then year after year we expanded and we tried to enlarge our product offering, and today we actually have products that are private equity products, sustainable infrastructure product, public debt product, and also in terms of thematics, we had expanded from financial inclusion to education finance, gender lens investing, and climate finance. And actually IIF, that is the acronym of the Insure Resilience Investment Fund, really focus on climate finance. So I guess everybody is fresh from COP26, and climate finance is certainly anyway a hot topic for both public and private investors. And as you know, I mean, there is a need for trillions of dollars to tackle climate change. And it's not only that there is a financing gap to get there, but it's also that the initiative, the financial initiative that you see on the market are mainly contributing to climate mitigation. And there is not much out there in terms of strategies that really contribute to climate adaptation. So that's why IIF, and I'm getting to the fund specifically, is unique, because it really contributes to climate adaptation. And just to put into context the fund, so the IIF was created by the German Development Bank, KfW, on behalf of the German government. It has been in the market from 2017, so it has already a few years of track record. And the objective of the fund is really to contribute to the adaptation to climate change. And to do so, the idea is really to try to reduce the vulnerability of not only MSMEs, but also low-income households in developing and frontier markets. So the fund has a global outreach, so it's a global fund as opposed to, for example, RegMIFA that has been mentioned before, and to let's say to achieve this goal. It has two sub-funds. So it has been structured from a, let's say, liability perspective with two sub-funds, one private debt and one private equity, and it's invested by both public and private investors. So focusing on the investment strategy of these two sub-vehicles, so on the private debt side, what we do is that we provide debt instruments to financial institutions and microfinance institutions, and we contribute to their loan portfolio. So an example of the instrument that then the financial institution gives to the end client is, for example, a livestock loan that is linked to a climate insurance. And of course, as you can imagine, this is not something that is obvious in all the geographies or for all the institutions. So then there is a facility that kicks in most of the cases, that it's a technical assistance facility and or premium support facility. So there are these two facilities aside on top of the financial vehicles. And thanks to this additional facility, actually, we managed to support FIs to structure a product that could really address their end clients' needs. And on the private equity side, actually, what we do in terms of investment. And as I said, we come from private debt and we have expanded to private equity. We started 7 years ago approximately, so it's also a learning by doing for us. So our experience in this case, this was our first private equity fund, is taking minority stakes in companies that are not necessarily only insurance or reinsurance companies, but all these companies that kind of contribute to the climate insurance value chain. So these include, of course, insurances, but also tech companies that really work on the collection and in providing data when it comes to weather forecasts. As I said, also in this case, also for the private equity fund, of course, the technical assistance facility as well as the premium support facility play an important role. And this, I think, it's an important element to go to more to the capital structure of the fund. So the capital structure of the fund, as I said, is partially public. So we have first loss portion that is approximately 25%, but then we have private capital that managed to come in thanks to the de-risking part of the first loss, and that the opportunity actually to enter into such initiative because of the blended structure, right? So we have Swiss pension fund, banks, investment managers that have really had the opportunity to make an investment in climate adaptation thanks to IIF. Thanks.
I'm not sure if I like my bad cop role today, but no, thank you so much. Yeah, I think we have heard 6 fantastic examples of successful blended finance vehicles. And all of you and us who have been involved in developing such vehicles or still are involved in doing so know how challenging this is. And especially also challenging when it comes to aligning interests of different parties, public, private, south, north, etc. So our next panel is going to discuss these challenges and hopefully solutions of how to overcome these challenges. So I'd like to call Roland to the stage. Here he goes. He was introduced before, but happy to do again. Roland Dominicé, he's board member of SSF and CEO of Symbiotics. Please also the other panelists come to stage.
So, I'm back. Sorry to come twice. I was very happy to be part of the SSF team who organized this event, and we were thinking with Miriam and Sabine that we would end with more of a conversation, and we were reminding ourselves that this is about building bridges, and so we actually wanted to try to incarnate or embody the different parties, let's say, and so we invited let's say a development bank, a public-private partnership, an impact fund manager, and a commercial bank, let's say, let's put it that way. And to be more precise, very happy to introduce you, Liliana de Sa-Kirchnopf, who is heading the private sector department at SECO. You've been with SECO for 15 years, 25, sorry. A big chunk in the private sector, a big chunk in Eastern Europe, and you were at IFC before the World Bank private sector arm as the DFI, let's say, in the story. If we move to the public-private partnership, I'm very happy to have Roert Broers with us. Roert has a lot of experience also in various different roles. I first want to thank you or excuse ourselves that being based in the Netherlands, you weren't able to travel with us, but most happy that you're here with us. You started your career in peacekeeping with the UN. You moved to the Ministry of Foreign Affairs in the Netherlands, and then spent 7 years at FMO, so did the full span. I think you've been on many, and still are, on many blended finance funds in the board of those funds. And of course, today you're the CEO of TCX, who's the perfect incarnation of a public-private partnership. So again, a big thanks to be here with us. And then if we move to Xavier Pierluca. So Xavier has a depth of experience, slightly younger maybe, but a lot of different private sector shops. So first with Deutsche Bank in impact investing, and then with Bamboo Capital. Started something called Enabling Capital based in Switzerland. So a full range of different initiatives. I think it'll be really interesting. And last but not least, Moussi Kidan, a big thanks for you to join us. Moussi has recently been cited as the most influential European fund manager and fund selector. So very pleased to have you with us. And he'll tell us more about his experience. He's your managing director in the role of head of fund selector and manager at Pictet Bank for 15 years. You were with Lombardier before that. And so you can very well incarnate the Geneva private banking scene. So I hope it'll be an interesting conversation. Maybe let me start with you, Liliana, just to get our brains going a bit. How does a government design a private sector policy? Meaning, how do you actually take national strategic goals or topics and then push them down in the private sector in designing a policy? And maybe you can give us a couple of the main current hot topics or key policy topics at SECO.
Thank you very much, and I hope the audience is still awake after so many rounds of panelists and speeches. Just to briefly frame SECO's mandate, so we have the mandate of development cooperation, and together with SDC was before on the stage, we are focusing on the economic side of development cooperation, and out of the total budget we have like 10+%. And within the economic development cooperation, what is key when you want to contribute to poverty reduction and development is really that you get the framework conditions right, because the private sector will develop once the framework conditions are there. If you have, security, you have a good business environment, you have a financial sector that is working properly, you have governance in place, and so on. So in principle, if this would be in place, that would be enough. Now, in many countries, it takes very long to introduce such reforms, and in the meantime, how we try to support private sector development on the ground is also with some demonstration effects that goes, for example, with blended finance structures that we try to demonstrate that investments are possible and profitable. But so the large part of our work is actually improving framework conditions, financial sector reforms, macroeconomic reforms, trade and investment regulations that need to be improved. Then we have some dedicated investment instruments, such as CIFEM. Claude Barras, the CEO of Opium, was here. It's professionally managed, so they do investments in developing countries. We have the SECO Startup Fund, which is for startup investments headquartered in Switzerland that want to invest in developing countries. We can provide them with loans that banks wouldn't give because it's too risky. We support pitch in the infrastructure area. And then we have some additional blended finance constructions. And I can talk about some of them later, but CIF is certainly the latest addition and the most prominent one. And I really would like to take this opportunity to express also my gratitude here towards all the participants.
Thank you. Maybe moving to you, Rourdes, you can tell us whether it was while setting up TCX or other initiatives you were part of, what are the biggest challenges in putting public sector and private sector money together in the same structure, and also, of course, the biggest upsides in terms of positives of that?
Yeah, so I think, well, first of all, thanks for having me virtually. So on the one hand, it's always it's a bit of a disappointment that you can't join, but at the same time, the simple fact that I can be with you virtually, I think, is incredible. So super happy to be there. Yeah, I think setting up structures like this, the key is always to find parties that are willing. It sounds actually pretty simple, but in setting up these blended structures, upfront, you're certain you will run into hundreds of challenges, problems, issues, smaller or bigger. But what I have learned is when all parties at the table are inherently motivated to make it work and they work towards an end goal, all of these issues will be resolved and flexibility will be found. Sometimes it takes a bit more time than others. But the willingness to make it work is actually the only key success factor in setting up blended finance structure.
Okay. And moving to you, Xavier, precisely, I mean, with your depth of experience in different leading investment management shops in our place, tell us a bit how you're using actually DFI or public-private partnership money to basically fundraise and enhance your strategy.
Yeah. So, I mean, first of all, I think when you engage in blended finance, right, and I'm going to echo what Christian mentioned earlier, you have to be a bit masochistic. We all are here speaking about blended finance, and it's a great tool. And I'm very grateful for the support of public institutions and development finance institutions as well that are providing, the first loss and mezzanine capital and support to different fund managers to achieve our goals, impact goals. Nonetheless, right, in order to be successful at raising a blended finance fund, you need to be a bit masochistic, as I said, right? I mean, it's a 36 to 48 month process that is highly iterative. I think, unfortunately, on many occasions, right, we failed to understand well, first of all, the underlying sectors where we want to channel investments to start with. And I think this is a key success factor. It's really to assess, the value chains of the different sectors that are tied to SDGs. And what it means is the flow of goods, the flow of funds, between the different actors up until the end client that we aim at serving at the end of the day. And as a result, being able to set up the right blended finance structure or the right vehicle. Why is this important, right? Because if you don't manage to define properly the aggregate return of your fund, with the different underlying value chains, you can't really go to the public institutions to start with, to build a case, why you want to invest in access to energy, why you want to invest in water, why you want to invest in clean cooking, which is a topic that is dear to our heart right now, at enabling capital. And then you fail actually to deliver, in terms of returns to your private investors as well. So this is essential. So the way we use it, I would say, is not very different from the way, and the examples that have been provided in the room today. This being said, not all sectors are conducive to the same, I would say, blended finance vehicles. In some cases, actually, you don't need a first loss piece. There are sectors in impact investing in emerging markets that, whereby the returns are high enough such that you can actually provide an attractive return to the first loss piece. And some investors are willing to take that risk. And this goes back now to the concept of securitization. If we think about it now in the 70s in banking, but also that we started with in microfinance, there were vehicles whereby we were offering, to the junior tranches, fairly attractive returns that could be double digit. This is still possible in impact investing, and I was involved in such fund, right, like 4 years ago with CIMA, whereby we had, this higher risk, higher return perspective. What we tend to see, though, unfortunately, and that's because that's the reality of the markets where we operate, is we need that first loss capital, and generally speaking, it's high risk and no return, right? Or it's high risk and very low return to start with. So yes, these blended structure facilities, I would say public capital at the bottom. I would love DFIs, by the way, to participate a bit more, and it's too bad Yvonne Bakoum is not in the room today, but to participate in the first loss pieces as well, alongside, European Commission's money and donor money that is coming from from several governments. Above that, I would say using public funding coming from DFIs, in some cases foundations, and then on top, right, the institutional and private capital. The gentleman at responsibility earlier mentioned, what is the level of subordination that you need? And I would think that when it comes to debt instruments, you really require at least 25 to 30% to make it happen. Another mechanism as well that is needed, and in order to be successful in tackling financing in given sectors and achieving SDGs or an impact theory of change, is also result-based finance, which is basically just giving money to companies. So looking at the supply side or looking at the demand side as well, and providing adequate, funding to customers in order to be able to purchase the goods and services that are provided by the companies in which we invest. So this is also another mechanism that we didn't touch upon today, but that is also one that we like to use for more difficult, if you like, sectors to tackle.
Thanks. Would you say in the design of all these different products that you worked on, is your interaction with the public sector funding more supply-driven or demand-driven? Meaning, do you feel that you're more implementing a policy topic, or do you feel more that you're catching on resources from the state that helps you achieve your goals?
Yeah, I think that's a very interesting question, right? I mean, on our end, I mean, in the projects I've been involved with, I actually reached out to public institutions and development finance institutions to pitch about topics, right? So clean cooking is one of them that has been left aside for many years because of the lack of profitability and growth in the sector and successful business models. This has changed in the last 5 years, and we brought this topic to the attention of the European Commission, the African Development Bank, and several other DFIs like the Belgian ones or the Danish ones, for example. So that was a bit, how to say that, entrepreneurial, right, from our standpoint. I guess, it's very fine as well to answer to RFP, no, and try to tackle the needs, of course, as a manager or as an advisor, that are being defined by these public institutions. Nevertheless, they don't always understand what is needed on the ground, right, these public institutions. So it's also important that managers take that entrepreneurial approach, if you'd like. It's, of course, a bit more difficult to sell and to reach your targets and objectives as a result.
Okay, thank you. And that's an excellent transition to you, Moussi, of really, there's different parties trying to understand different needs. I believe, I'm not sure if Pictet Bank has actually invested in a blended finance fund yet, but you're definitely seeing this industry coming towards you. There's new regulations, especially in Europe, that are pushing banks to abide to the EU SFDR norms, especially with a call for Article 8 or Article 9 funds, so those who have let's say, an SDG intentionality. How does that affect your world in terms of selecting third-party managers and third-party funds? And do you see it as something positive, this regulatory push, or how do you tackle it?
Good evening, everyone. Yeah, indeed, what we observe is a regulatory push towards the sustainability. But it's not only regulatory. This resonates well also with both institutional and private clients. So the way we try to do this is simply to have a framework. Again, everybody had their own idea what sustainability is, how to achieve it, and so on. But as a firm, what we try to do is just to come up with a framework, what's important, and have a common language, at least within the firm, what to see, how to invest and how to measure. So that was the first step that we did. And we did this well before SFDR was the rule of the day, basically. So what that means was simply for us to really think about what are the most important points, how to address them. So basically, we have a 4-pillar framework, and this is applied across the firm, both on the institutional side, on the private banking side, and also we do have a unit called PICTA Alternative Advisors, where they do direct and indirect investments. So basically, it's the same framework, although it's applied differently depending on the channel that we are looking at. So yeah, that's one point. And then what the SFDR brought is simply to have probably common language, both on the asset managers providing these products and also us on the buying community, just to have. But then again, it's also a new game, and you have certainly heard about greenwashing and so on. We are confronted with a lot of these things, but then again, to the extent that you have a framework, and we think we have one with all its shortcomings and so on, but at least it's a starting point, and it's a level playing field to all asset managers that we look across the value chain. So that's how we are handling this.
Okay, thanks. And I think regulation, maybe we didn't emphasize it enough this afternoon, but is really, I think, the key game changer of how you mentioned the framework conditions, our Swiss way of talking about regulation, of how we actually shift a market. But there's, of course, other ways in terms of focusing on changing managers, changing products, or changing the plumbing, the infrastructure in the market. Maybe, Roche, you can tell us how your work at TCX actually helps to engage with mainstream markets. I mean, how are you, in a sense, creating new tracks and new markets to attract mainstream capital in developing countries?
Yeah. Thanks, of course, super happy to do so, especially since I just realized that the entire TCX ecosystem is represented in your panel. I mean, we allow impact investors to lend, invest in local currency. So we take away the currency risk from the likes of enabling capital, Symbiotics, RegMIFA, Big Line, but actually a very significant part of our business is with Swiss impact investors, impact fund managers. So we take away the currency risk ultimately from their clients. We bundle it in the fund here at TCX, where we manage it based on diversification and the use of local interest rates. And we are allowed or able to actually concentrate all these risks here in the fund thanks to very patient capital, amongst others received from your government, from SECO. So we're super happy with the existing and the continued support from SECO. So we warehouse the currency risk. And originally, we set on the currency risk until, let's say, the underlying loan would have matured. And we would unwind the swap and go for a new loan. But since the fund was growing actually quite rapidly, there was a lack of ability for us to take on additional risk. Well, in order to take on more risks, there's two possibilities. One, you increase your capital, which we've been doing actually quite successfully. We doubled our capital over the last 3 years. But two, you need less risk. So we started sounding out the market, whether the market would be interested in taking on the risk of Papua Guinea guineas or DRC Congo francs. We started doing that seriously about 5 years ago. And we are now learning that there is indeed a significant demand for frontier currency risk. So that brings us, let's say, to also the fourth member in the panel. Commercial investors, fund managers, asset managers, private wealth management companies, even some institutional investors are actually quite eager to take on the risk of 5-year DRC, Congo franc, Tanzania shillings, Rwandan franc, on one important condition: they don't want to take on the credit risk. So in combination with our AAA rated shareholders like IFC, EBRD, FMO, European Investment Bank, we've been repackaging the risk that we have in our books. So they've been able to issue AAA rated Congolese franc bonds bought by institutional investors and asset managers. And in doing so, actually, by now, I think about 40% of the frontier currency risk that we have in our books has been taken on by the private sector. So originally, we did not expect this to be possible, but we have catalyzed well over $1 billion, let's say, of private sector investments now in these currencies. And even more exciting, we've seen both in Georgia and Uzbekistan, where we had issued between 10 and 15 of these frontier currency bonds, that quite a number of these investors, instead of remaining offshore, they got used to the market risks of these currencies, and they actually developed an appetite to go onshore as well. And it's actually the Minister of Finance of Uzbekistan mentioned that their first ever offshore Uzbek Som bond was oversubscribed 2.5 times because the market already was familiar with Uzbek Som risk, thanks to the 15 bonds that we had structured before. So there's actually, I see it as a fantastic way to first get asset managers interested in the market risk, and by doing so, slowly but surely, get them actually to take the shore risk as well and start investing first in government bonds, but then going down also in the financial sector, what we've seen. So there's the direct effect of catalyzing the private sector, but I think more importantly, it's the effect of getting the private sector institutional investors used to the fact that these frontier markets are not as risky as they are perceived to be.
Excellent. So we have, after talking about the regulation as the key, I think, tool for policy investors who want to crowd in the private sector, or seeing an example of infrastructure, the two missing links are the products and the managers. And maybe, Liliana, you can mention at SECO, what are, let's say, good cases or things that worked in terms of providing blended finance to a private sector product, meaning an investment fund. I know you've done 3 or 4 over the past decades.
Yeah, maybe a couple of reactions. So our just approved investment into T6 is I think of 10 million. I think is really an excellent example of blended finance, because again, in principle, we're working on deepening capital markets in developing countries so that more currency lending will be possible. But since this takes time, we need immediately some solutions. And it's about impact, because if we all lend in US dollars or in euros in these countries, you know, and at the end is an SME and has to bear the currency risk, then you know, they may lose out if the local currency is depreciating. So again, through this blended finance, and from a public side, we're investing in a first loss tranche, and in 2045, hopefully we will get the capital back and maybe with some return, and we will have achieved a lot of impact based on the track record that T6 has so far achieved. So blending for us is always making the best use of investing a franc or a dollar and getting most impact out of it, because we're really using taxpayers' money, and every day we have to think how to maximize the impact the US dollar. And that brings me back to our blended finance approach. We have been doing blended finance for 20 years or more. And at the beginning, we were doing individual transactions or setups. We have done green credit lines, which were exactly also something you were saying, paying for results. So we would team up with financial institutions in some countries like Peru, Colombia, or Vietnam, and then the banks would lend on to SMEs that would use new technologies to reduce their CO2 emissions, and a part of the loan would be reimbursed once they would have achieved a certain amount of reduction. But then the scaling, you know, you have always to design things that it is being scaled up and taken up by the local system, and that's not always so easy, because then the regulation comes again into place, right? It helps if there is regulation saying you have to lower your emissions by so much by then. But then, so we had, in the early days, we supported some impact investing funds through TA or through taking a first loss investment. And then by time we saw that the ecosystem in Switzerland grew. And the very first investments were with international funds, because there were not yet impact investment funds in Switzerland. And then with time we saw that actually more and more players were established, and now we have a vibrant ecosystem, as was showed this afternoon. And so we moved to a new approach, which was the SECO 17 call, where for the first time we defined two objectives. We said we want to support impact investment funds through technical assistance that contribute to 2 SDGs, either SDG 8 on job creation, decent work, or SDG 13 on climate action. And we didn't say you need to do this and that and in this country, so it was quite open, besides these 2 goals that you had to make a contribution to with a credible, you know, theory of change and the credible, you know, everything. But by going out in a transparent and competitive way, we could compare different proposals, and that gives you again a bit an insurance on additionality, you know, because if just one investor is coming, how can you know if it's really, really additional, or if a little bit less would have also made the case, right? So in this competitive way, we could also ensure a better value for money, which also was also then demonstrated in the ratios of TA compared to the fund size. And we could support very interesting proposals, 2 on SME finance and 2 on the energy side. And one of these funds, the RARI fund, now just recently was converted into Serengeti Energy, which is now an African independent power producer, and could really also make a transition into a local established fund. And so there are many different ways, and the CIF initiative that was today announced goes even a step further, because we will look at the innovation side, which in SECO 17 we had a little bit less, because we worked with established funds already. As a first time, we didn't want to add all the risk layers at once. So we said, let's do TA, let's work with established fund, impact investment funds. And CIFI goes now a step further. We will have more opportunities in terms of risk also. We can take more instruments from first loss, TA. Let's see what is possible within the administration.
Thank you. Maybe a last question to you, Musi. So we have the regulation. We have the infrastructure. like TCX. We have blended finance funds and managers. What's missing for you as you approach or look at different managers to move from, I think we saw this morning, we only have 1% of the whole world AUM in impact investing. What's missing to get to the next stage?
I think there are two things that are crucial. First and foremost, from what I see, and I have probably a small range of views, but what I see simply, there's really a communication gap. The development finance actors and the traditional financial actors, it seems like they don't speak the same language. So bridging that knowledge gap is going to be crucial. And the second thing, and coming from the traditional finance institution, is most of the developed finance actors might have a very good idea, both on investment and impact, but at the same time, they lack the institutional framework to tap into this capital base that we are custodians of. Again, we have our primary fiduciary duties to our clients, and when we hand over, or at least invest their capital into elsewhere, we have to make sure and ensure that we have all the necessary safeguards and so on. So mostly the institutional framework is missing. Yeah, so I think there's an important, I would say, bridge to make between the two. And also, I mean, the traditional investors that we are lack also a deeper understanding of the impact that these projects might bring and how to measure them, and also how to communicate that to our clients. It's not that our clients are not interested. They are, as a matter of fact. But it's how do we make sure that what we are told that the development finance people say they do is actually what they do, and how to measure it and to showcase to our clients who entrust us with their capital.
Thank you so much. And so I guess that's a key lesson, that everything exists, but we still need to work harder. And the institutional framework, or having strong companies, strong asset managers, is key. And so back to us, like, Xavier, as asset managers, we're not there yet. We need to step up. We need to institutionalize ourselves. And I think that's a key message. You want to say a closing?
No, just on that front, without speaking of us specifically, of course, but I think also what is needed is that we come from microfinance, for example, right? And the largest asset managers in Switzerland all come from microfinance. Many or some have managed to diversify, in different sectors and branches. This being said, right, we don't know it all. And I think we need to support innovative and new fund managers, right, that are going to come at the forefront tomorrow. And I touch again upon the point that Christian raised earlier, right? It's extremely costly to structure a blended finance facility. From a legal standpoint, you need a team that is capable, that you're going to employ to do so. And of course, we can do it from the largest players, but we might want as well at some point, or the Swiss development actors might think of supporting with a program, new impact managers and new fund managers as well. Just like SeedStars is supporting new entrepreneurs, we can support new fund managers. And what is needed is working capital, advancing for the structuring fees as well for these players, and potentially helping them, to invest, to put the money as well in the funds, as their participation, the 1% that is required of all fund managers, right? Generally speaking, when we launch a blended finance structure.
So that's
a call for, a bit more.
Yeah, no, so I read it as a key call, and I know we're overdue, so we'll stop, but it's a key call maybe for SIFI as an agenda point to help create new asset managers in Switzerland and maybe reinforce the existing ones to get from 1% to the closer to the 100%. Do we have time for a closing word to Roerd on why Switzerland? A very short word. So we'll close with you. You're a witness of all this. You realize that you're very large on top of the wall, so you feel very important to us right now. Being based in the Netherlands, who's also one of the key markets in Europe, why Switzerland? I mean, why is the Swiss market, from your perspective, leading with 35% AUM?
Well, it's indeed fascinating, and I think, well, of course, Switzerland, Swiss banks, asset managers are sitting on a huge pool of funding, and part of that goes, of course, into impact. And I think since you were amongst one of the very early movers into this market, Switzerland was allowed to build, let's say, a leading position, specifically indeed in microfinance. Despite, let's say, the cost disadvantage that you have, as most of you as fund managers realize really well, you've got a relatively high cost base, which in microfinance adds up quite rapidly. But it's been impressive. I mean, Switzerland has built a very vibrant and innovative asset management industry. But indeed, I think the weakness for the future is that also for the industry's own benefit, you need to diversify away from microfinance. And what I hope, not only for the Swiss asset managers, but also, let's say, for the future of impact investing, that you find a way into renewable energy, maybe through off-grid or rooftop solars that has a lot of, let's say, similarities with microfinance, moving towards also larger renewable energy. Because I think that sector is in need of your experience and in need, let's say, of your ability to set up new impact funds. So I hope you will help us and the planet by moving from microfinance also to renewable energy.
Thank you so much. Thanks to all of you and each of the panelists for this conversation. Back to you, Sabine.
Well, thanks a lot to all of you from my side as well, and especially to Roland for moderating this last session of this afternoon. And I don't know how you feel. I feel I learned so much, not just this afternoon, throughout the full 3 days that I already was at Building Bridges, and I'm so proud of all these colors. Today was the green day, but it was actually the SSF day, and that would more be blue, because we presented the recommendations we published with Amas last week on Friday. We presented them today. Over lunch, we presented our roadmap for Switzerland, and we're positive that we put together different sensible measures for the different players, and we need them all to really get to where we want. And this afternoon, we had such a rich session, and I can really only thank to all the speakers that offered their know-how. I'd like to thank SECO for taking the opportunity and present SIFI here, and I'm convinced it will really help grow the Swiss impact sphere further. We need that, we heard it also. I'd like to thank the SSF work group that also put some thoughts into today's session, but mostly Miriam Garson, who really put to organize today's session for us. And you can't believe what she went through also with last-minute changes given the current situation. So there was lots of emails and phones and all that. But I would mostly like to thank you for having joined us. And now it's time for a drink, and SSF invites you to join us out there and cheer to Building Bridges that really makes it possible to stir this whole development and make it grow further. Thanks for having been with us.